Well, good morning and thanks for getting up early to coming along. It was a bit tough, wasn't it? But anyway, we're here and we're the lucky ones. So just first of all, what I'm going to do in the next 15 minutes is just briefly run through some of the drivers that are affecting the ASX resource sector at the moment and the opportunities there. If we average all the ASX companies' share prices over the last 2 years, you can see the graph on the screen. We had the big slide of 2023, the average share price dropped considerably. We had a Santa Claus rally that followed. Then the early part of 2024, the slide continued. And then in the last month or so, we've seen that average share price increase dramatically. And that is for a particular reason. And that is if we divide the ASX market up into 4 quartiles based off market cap, the first quartile sitting up above 66 million market cap have driven up the market 68%. They've risen 68% over the last 12 months on an average. Sorry, over 2 years, and 27% over 12 months. Over the last 3 months, which is a period we'll look at, they're up 13.6%. The second quartile, $18 million and above, to $66 million, are up 13% over the same period as well. Compare it with the fourth quartile. That's the lowest market cap, 25% of the ASX resources market, and they have fallen 49 or nearly 50% over the last year, and they're down 19.4%. So for investors, stick in market caps above $16 million. That's the first takeaway there. And that's what's driven up that average, because they've been in commodities in demand. Now, if you take a look at, you can go for 2 areas of the market. Some people are day traders and they like to look at what's driving up at the time. They're on the screen the whole time. But if you take the companies whose share price rose the most over a particular day, and you look at it 3 months later, and you take the standout from our Austex reports. Every day in the Austex we have a standout company. Today it was Kingston. Go and have a look at their booth. They're about to move from tailings onto hard rock gold. But if you do, over that particular period of study, the day traders companies 3 months later were down 21%, whereas ours standouts, in other words, good projects, people doing things and making things happen, were only down 1%. Stick with the good projects. Well, another thing to look at when you're looking at companies is how are the commodity prices moving in respect to the share price market. There's a great opportunity in manganese at the moment, driven by Groote Eylandt shutdown, which will be off for another 12 months. The manganese price has risen in the last 3 months 34%. That's manganese ore. And the share price 16%. So there's still opportunities there. But the biggest difference between commodity prices and average share prices over the last 3 months is coal. Coal is risen. Thermal coal is up 27%, yet share prices are down 4%. This is because of the woke inner city suburbs that think that coal is finished. Absolutely not. We heard yesterday from one of the speakers that there's 22 new Chinese coal power stations have been built. So there's a great opportunity to have a look at companies like Whitehaven and Stanmore, and Bowen Coking Coal is another one here. They're all Bowen Basin companies, and go to the Bowen Basin Coal booth. And they've been driven. There is funding available for them. It's a good area to look into. It isn't going away anywhere soon. There's not one green. There's not the greenest of greens or the tealest of teal that's going to change their lifestyle. So we're going to be using coal and other minerals for a long, long time. Lithium, of course, the price went down, but if you look at the price of lithium over the last 3 months, lithium carbonate is up 15.7%, but the share market is still down 10% over the period of time. So there's opportunities to get back into the lithium market. Manganese, as I mentioned earlier, and the others I mentioned there. We better move on because time is a-going. All right, so what is the other thing to look at is how hard is it to get a commodity into production? And one of the big talks around the booths yesterday that I picked up was the difficulty companies are having with project financing. In other words, getting into financing their projects when they do it. Gold and silver is the easiest to get off the ground. You know, the metallurgy is proven, it's easy to market, and you can send your gold off to the Perth Mint or wherever you like and just tell them it's on the way and you'll get the market price. And if you're here in Sydney in September, don't miss Kerry Stevenson's wonderful gold conference. She'd love to talk to you about that. Others that are quite easy are the LME metals, copper, lead, zinc, tin, tungsten. Pretty straightforward to a concentrate, established LME market, and there's good ASX producers to show the way. Oil, gas and coal are good, but it does fight political challenges, but there are many successful ASX producers that you can look at. The others are moving down the line. The hardest of all is graphite. There's no market for graphite concentrate. You've got to go all the way into producing anodes, and that is a difficult business. Vanadium is much the same. Nickel and cobalt at the moment are struggling due to the dominance of the Indonesians and the Chinese players. Rare earths, easy to find, but difficult to get past producing a mixed rare earth concentrate. Have a look at companies like Hastings and Arafura and how long they've taken to get off the ground. Where should you invest? Okay, well, this is the little average investment curve, wish curve, if you like, for a project as it is developed. And within the AUSTEX reports each day, there's sections of things that are happening. So we have people who are looking for that rise in what's coming up in drilling, looking in sections G and F and C, E of our reports, or F and G of our reports each morning, and you can monitor how what sort of results are coming out in section E. That's the area where you get drilling continuing to build a commercially viable project with attractive resource estimates. So get in at the start of a drilling on a good project and write it up. You can even wait till you get us the first hit made and drill intersection. The price will go up, yes, but it'll come down 3 weeks later, then have a look at it. There's great ways, companies like De Grey's, Chalice and companies like that have found big deposits that you could buy into cheaper sometime after the first discoveries. I've also mentioned the period that you've got to then probably be out of the market during that long period. As I talked earlier, it's difficult to get project financing. It's getting harder and harder to get social licence to get a project up. And so that's a long period of time. Unfortunately, the companies suffer, that it's not so attractive for investors. But finally, after the project gets up and running and to nameplate, and yesterday Bellevue got their gold project operation up to nameplate, they're away to the races. And again, you can come back in and look at investing in that company with certainty. One of the things at AUSTEX we do is we put together all the Appendix 5B cash flow reports. So look at capital raisings by explorers and emerging companies. So 88% of all resource companies put out a cash flow report. They have dropped from a peak. They rose up during COVID to a peak of Q4 21 of over $3 billion was raised on the ASX. Dropped down to this last quarter, March 2024, to under $1 billion again, to 992. It's a bit sawtooth down, so there's not as much capital being raised on the ASX. There are more companies because there's been a lot of new floats over the period, so it's not such a flash situation with capital raising. What is the capital being raised for? If we look at the last 5 quarters, in quarter 1 and 2 of 2023, the predominant area was gold. That shifted in quarters 3 and 4 to lithium, and in the last quarter, the most money has been raised on uranium, down on the far side, particularly for uranium projects that are about to come into production. So the biggest capital raisings of the first quarter were Deep Yellow for their project in Namibia. They're moving it forward. Syra, oh God, more money, back drinking from the well for their graphite project. Renogen, great gas project in South Africa. You can see there's a number of uranium companies and gold, a few gold companies, oil and gas companies scattered around that list. But that's what the big capital raisings were for. If we look at exploration expenditure over the last 7 years or so, and in particular the blue line, the blue dashed line, which is the first quarter, because always exploration expenditure is lower in the first quarter as it's the off-season for exploration. It rose up and hit a peak in the first quarter of 2022, but since then, over the last 2 years, it has been slowly dropping. In the first quarter of 2024, the ASX market rose companies spent $745 million collectively on exploration. Where was the exploration spent? What commodities? Again, it's the same story in first quarter and second quarter of 2023. It was for gold. Third and fourth quarter of 2023, it was for lithium. And in this quarter, no, it was not for uranium. You can see it's hardly moved. The money's not been spent on exploration. The money raised is being spent on developing those projects into production. The Paladins and others of this world. The last quarter, the most was still spent on lithium. Even though the price went down, there was more money spent on lithium exploration than anything else. And it was probably driven by the situation in Western Australia, where there are a number of majors running around picking up as much spodumene that they can. And that would have been driving that. They're also reasonably healthy in gold, of course, as the gold price came back, and oil and gas, and a lot of expenditure on rare earths too. There's a honeymoon sort of situation with rare earths in Brazil at the moment. The largest exploration spend, it was by Strike Energy in the Perth Basin for oil and gas. They run into a few little problems there. Gallon in Argentina, they're sort of starting to develop up, I think they're here, but they're starting to develop up their brine project. De Grey, of course, always spending a lot of money on gold and always quite successfully. Genesis, what a story, great story that is, how they've put together the remnants of the disasters of St Barbara in around Leonora. And the others going down the list there, a lot of lithium companies still with the big spenders. So cash is king, isn't it? Cash is king. So who's got the most cash? Graphite companies. It's because the markets put a lot of company money into them and they can't spend it because they're not able to get their project up to where they can find a market for it, because there's no market for their concentrate and they've got to go on and develop how to build an anode. Heavy mineral sands got lots of money because of the mineral monazite. Monazite we used to throw away in the early days as a waste product, but nowadays, of course, it contains rare earths, and so they've got money for explorers. A number of them in the Murray Basin, for example, are in that category. Lithium companies have got a lot of money, oil and gas, and unfortunately, there's a lot of talk at the moment of copper, but the companies don't have much money. They're over on the other side. So let's hope we can see some decent capital raisings for copper. Liontown Resources have the most, and they need it too with the project they're trying to develop there at Kathleen Valley. West African, a great gold producer in Burkina Faso, De Grey, also well cashed up, also Genesis and Capricorn Gold on the gold side, a number of lithium companies also. Quite a lot of cash. Time's running out, we've got to move on. Okay, let's look at costs, and the great way to do that is to look at the gold producers. And if we look at the gold producers over the last 5 months, and we look at their all up sustainable costs, the best have been Emerald over in Cambodia, and the best in Australia has been Ramelius. And the average has been $1,748 Australian an ounce to produce, and you'll notice how that's risen up PCP from $1,610 last year. That's an increase of 8.6%, and that is the best indicator you'll find on inflation affecting the mining industry. The other thing that's of concern, if we look at the quarterly reports, if we look at the actual amount that the companies put into saying that they're spending on exploration for the quarter, it's been declining. The first quartile exploration spend from 2022 to 24 is down from about $1,100 to below $1,000 million. $100 million. And the rise in staff and administration costs, you can see on the bottom there, they've been slowly rising. So the difference between, if you take the difference between the two as a percentage of the exploration, we found that this month it's 75. If you add staff and administration together, it's 75% of the money that's being spent on exploration. If we go back 2 years ago, it was 51%. So we are using, companies are using more of the money that they raise from the market on staff and administration. There is too much red tape, too much green tape, too much whatever tape you like, and that's causing a problem for the companies, because this is what's happened. You can see, if you look at the new drilling results announcements in the section E of the AUSTEX reports each morning, you'll find that they have declined down in 2023 from over 2,000 in the year to just over 1,500 separate ASX resource results announcements. So there's less being spent, there's less drilling actually happening. There's less drilling going on. And if we compare the section E of our reports over the years since 2018 with section G, section E is the drilling results, and section G is where we're talking about soil samples, geology, geophysics and so forth. We used to talk more about exploration drilling results, but now we talk more about rock chips. You ever seen it? The number of companies that are coming out and found a rock chip in the market is away to the races. And so there's more being spent on that, and that is not finding ore bodies. That's about it. So if you'd like to know more about the AUSTEX reports, then please send me an email if you'd like a copy of this presentation, because it has been quick and I apologise for that. There's no other way to do it, or you'd like a trial subscription to AUSTEX, please give it a talk. And if you're short of money, then I can recommend the AUSTEX Lite. It's a low-cost production that looks at the share prices and commodities each week. And it's back to our wonderful host. Thank you.
Thank you. Thank you, and thank you for everyone for being here early this morning to hear the Stellar story. It's a very exciting story. We're a tin-focused company in Tasmania, and really pleased to present the story to you this morning. We own 100% of a project called Heemskirk in Western Tasmania. There has been a lot of work done on this project, about 50,000 metres of drilling over the years, companies like Aberfoyle, etc. In 2019, there was a comprehensive scoping study done on the project, and really nothing's been done there since then other than drilling in the last few years. We've just upgraded the resource on the project late last year, and we're now looking at new studies on the project, re-scoping, and that'll lead into a PFS as we move down the track. So I'll take you through the old scoping numbers in the slides to follow, and then I'll talk to you about what we expect to get from the new studies that we're doing. Tasmania is a great place to work, excellent location, great infrastructure. The project will be fully powered from 100% renewable energy. In fact, Tasmania runs solely on renewable energy, all the hydro and the wind farms. We've got great access to world markets. You can see Burnie to the north on the coast there. It's about 150 kilometres on a sealed road where we'll take our tin concentrate to the ports. I was down there last week. I drove that road. It's a great road. It's where Renison takes their material up to the ports, and all the infrastructure up there for us. We visited quite a few projects down there last week. We met with the mines department. We've just reconfigured our board, so we're getting active on that front. We've been in to see the environmental authorities last week as well, and it's very pro-mining down there. It's a fantastic part of the world to be working, and I've just been working in Africa for the last 7 years, and it's nice to be able to work in a place that you can actually go out in the streets and feel safe and get on with things. Tin is a fantastic commodity. I'll talk to you later in the presentation on why we're excited about tin. There's a fantastic demand scenario going on. There's a supply shortage going on, and the tin price is currently about $32,000 US, and our old scoping numbers were done around 2019 at $20,000. So there's going to be a lot of movement in our scoping work. So let's look at the snapshot on the corporate side. As I said, we've just reconfigured the board. I've come on as executive chairman in the last 3 months, and I've brought on the board Andrew Boyd, who's worked with me in Africa. Andrew and I have had a successful track record working together. Previously, we were running a company called Oklo in Mali in West Africa, and that was bought out by B2 Gold about 1.5 years ago. We like this asset. It needs a lot more work as far as exploration, geophysics and studies, and it's a great asset to be working on. Market cap fully diluted at the moment, it's about $30 million. We've got just over $4 million in cash. We welcome Nero Resource Fund onto the register in the last 2 months. They hold a 19.5% interest in the company. So we're well funded going forward, and pretty excited to get the rigs rolling back onto the project and get into the work. A bit of a snapshot on where we are. You can see, world-class deposits all around us. Renaissance Tin Mine, owned 50% with Metals X, and Yunnan Tin is about 20 kilometres up the road, sealed highway. We're at Xian there in the middle, the Heemskerk project, and to the west of us is the Avebury nickel mine, which is about 8 kilometres on sealed highway to the southwest of us. Avebury's just gone into care and maintenance, unfortunately, with the nickel price, but that may be an opportunity for us, and certainly there's options for us to work 2 work streams here to look at potential standalone project or potential toll treating at nearby operations. So we've got secured mining licenses here. We own them 100%. As I said, we've got great access to world markets through the port, and you can look forward to updates coming from us in the next ASX releases on timing for drilling, for updating scoping studies and our development work. You can just see the inset in the circle there, and that's the deposits we've got, and you can see that's an outline of the tin projects. And really what I'll talk about is Severn and Queen Hill, which are the 2 you can see down the southern area there. They'll be the main projects that we'll be developing first. There are some other smaller deposits there that we'll get to later. But as I said, this is an area that's very pro-mining. Xian actually was established in 1861. It was going to be the capital of Hobart. There was a lot of guys came in there and prospectors, and we're looking at the lead, silver, zinc, which sits at the top in these systems. So there are old workings around. And then as you go down in the system, you go into the tin. And the tin was never looked at because back then they didn't have the processing technology to extract the tin. So there's been no extraction of the tin in this area. There's a slide through the Severn deposit, which was the larger one you saw on that inset. And you can see the black line there. Anything within that black line is our indicated resource, and you can see the pierce points there from the drilling. And just to put it in context, tin's not a well-known commodity for a lot of people. So if you think a % tin in today's market is around 4 to 5 grams gold equivalent. So we're looking at 5-gram ore bodies here. So you can see a very good numbers there, 30, 40 metre wide zones at over 1%. As I said earlier, we don't think there's been enough geophysics and geological modelling done on the project to date. We're going to go back down a lot of these holes and do some downhole EM, which is very successful in finding tin associated with sulphides. And if you have a look at what Metals X has been doing recently, they've just discovered a new deposit called Ringrose, which is away from their mine where they've been successful with their downhole EM. So what's the drilling that's been done here is really focused on the 2 main deposits. They'll be the focus of our scoping and our studies. But we also believe there could be some blind bodies there that have never been looked at and never been tested. The resource that we put together late last year is 7 million tonnes at over 1% zinc. So again, I'll just convert that back to gold for those who like to convert for a gold equivalent, we're looking at 1.2 million ounce ore body here, okay, in gold, and half of that is already in indicated category. So we're looking at a total resource here of over $2 billion in ground US in ground at this stage. There's room to expand it. As I said, we're going to have drilling starting. We're going to have 2 rigs down there shortly. But this is the resource that is going into the scoping study, and it's going to be the prime focus on our feasibility work as we move forward. Where do we rank in globally? We've got the highest grade undeveloped tin project in Australia, and we've got the 3rd highest project globally. These are all the projects that are undeveloped at this stage. You can see Heemskerk sitting there on the top left, and our aim is to move that circle to the right and upwards, so add tonnes and add grade. And as we move forward with our drilling, I think we can successfully grow the resource and move things along. So just an outline of what was done in 2019 in the scoping study. The figure on the left there is you can see the mine development in both the Queen Hill and the Severn deposit. Geology is an amazing thing. This ore body actually sits on the top of that, outcrops on the top of the hill on the right. So we'll be putting a portal in on the side of the hill. The town of Zeehan's on the other side of the hill, so we'll be totally shielded from the town site, and drive a portal into the side of the hill and long hole stoping method for the mining here. The old study had a mining rate of about 350,000 tonnes per annum. We think we can increase that with the new resource that we've added tonnes to. It'll be underground mining here, so very low footprint in this area. We actually were in seeing the EPA last week, and we're starting there's been a lot of baseline work done here, but it's been done about 10 years ago. So we're working with the EPA now on progressing environmental studies, because we have got granted mining licenses, and there'll be about 12 months of baseline study work here to then lodge our notice of intent and get guidance from what needs to be done further from the EPA, and then that will give us the final tick-off when we can start digging and then start building the project. There's a high level of inferred resource still here, about half of the resource, and we'll be looking to move a lot of that over into the indicated category with ongoing drilling. So these are the old figures from 2019, and remember this was done on a $20,000 US tin price, and you can see there at exchange rate of say 70 cents. The current tin price is $32,000 US, so we see a lot of upside on our scoping work, both on the price of tin, both on the mining rate which we can increase due to the size of our resource, and it's look at the capex is on this project back then was 60 million Australian. That's probably 120 now with escalations. So it's a fantastic project. As I said, we're really looking forward to getting the study work done and updating the market. We should have that out in probably Q3, and then we'll make a decision then to go straight into a PFS after that. So I've talked to you about the project, and what the last comments will be on why we're excited about tin. Tin is, it's ranked as the #1 as the metal that's most placed to benefit from new technology. So tin is in everything. It's 50% of tin is used is solder. So everything, your phones, your washing machines, your cars, your computers, everything has tin in it, and it's what joins all the wires together. And it's the solder. It's the glue, we call it in electronics. So 50% comes from that. But there's also this massive increase at the moment in solar, in AI, and in conductors and automotive, and that's about 30% of the demand at the moment. So it's a growing demand, but there's a pending deficit which predicted by both the ITA and Macquarie, and you can see the tin price here, and you can see a big spike there back in 2021 when tin rose to $55,000 US, and then came off. What's different this time is that, I'll show you shortly, is the supply is diminishing. So we've had a big deficit in supply. 70% of the world's tin comes from China, Indonesia, Myanmar, Peru. So, and 34% of that in that pie chart down the bottom, 34% of that tin is currently being cut off. Myanmar state suspended all tin mining in 2023. Their projects, alluvial, are exhausted. So that's been taken out of the equation. Indonesia's banned all unrefined tin exports in 23. There's corruption inquiries going on there. Most of their deposits, again, are alluvial, shallow, largely being depleted, and then the deeper stuff's offshore, and they're having trouble with artisanals. So there's a real shortage here. You can see the figures on the left. There was about 300,000 tonnes of tin concentrate produced in 2023, and then the refined tin going through the smelters was about 373,000. So there's a 22% shortfall already last year in 23. And without Myanmar and Indonesia's supply, this will cause about a 50% shortfall. So there's a really growing thesis for tin moving forward. That's why we're excited about the commodity. And there's very few tin producers. There's very few tin projects. Rob just presented, and I don't think he mentioned tin. I saw the numbers up there, but that's a benefit for us, and we're really going to capitalise on this as we move forward. So just to sum up, we've recently placed some money and welcomed Nero on. We're fully funded at the moment with over $4 million. We've reconfigured our board to take this project forward. We're going to be doing work streams including scoping, geophysics and drilling, metallurgical test work, and then move forward to feasibilities. And yeah, that's about it. And thanks for your time. And glad everyone could make it early to be here. Cheers.
Once upon a time, there was a young geologist, English geologist, who studied hard some of the time, and he was offered a job and a visa to come work in Australia, and part of the original cheap immigrant labour in the late 1980s. And I worked for a company called Western Mining Corporation. I was in the project generation team, and our job was to draw boxes on maps where we thought world-class deposits would be. And we studied a lot of those world-class deposits, looked at what was common to them or different to them, and that's what we tried to do to help find the next generation of major deposits. So I took all those skills, drew boxes on maps for a number of companies as a consultant before deciding I should draw boxes on my own maps, and so we set up Impact Minerals way back when, with the aim really of discovering a world-class deposit. But during that period, I learned a few things, and one of the things we learned very early on in Western mining days was don't get into bulk commodities. Don't get into bulk commodities, because if you do, one of four things has to be true in order for it to get through the mining cycle. The first one is it has to be large. It has to be one of the largest things, so like iron ore and coal. The second thing, it has to be exceptionally high grade, again, like iron ore in the day, BHP and RIU dominating the market. Thirdly, you have to be first to market, which really means having established client relationships. Or fourth, you have to be the lowest cost producer. And so we steered away for many years and just really sort of focused on gold, nickel and copper because of those rules. But the other thing we also were taught was don't go to the Pilbara looking for multi-million ounce gold deposits because there aren't any there. So during my period in my career, a few things happened. So FMG found low-grade iron ore and turned it into a world-class deposit because they're the lowest cost producer. And amazingly enough, De Grey, who'd been around for a long time, discovered 10 million ounces in the Pilbara. And so a lot of the things I learned early in my career turned out not to be true. But one thing I did learn was that it's actually not worth getting out of bed in this business for anything less than a world-class deposit. There's too many one-mine companies. The market caps very rarely get above 150, 250 million. Whereas if you make a major discovery like De Grey, you'll hit $1 billion market cap without turning a sod of earth. And so I find myself today talking to you about our Lake Hope project in Western Australia. Amazingly enough, it's a bulk commodity. It's high purity alumina, but I truly believe that it's a world-class deposit, and I'm going to tell you about that as we go forward now. This is Lake Hope. It's 500 kilometres east of Perth. It's a magical lake. We like to call it the magic lake, not just because of how it looks, but in the top 2 metres of that salt lake is something in the order of $20 billion worth of high purity alumina, just waiting there to be dug up and processed. It's an amazing discovery. It's an amazing deposit. We have a joint venture with it. I can talk about the terms, but by the end of this year, we should own 80% of this project and all of the IP that goes with it. It's world-class because of the economics. You can look at this scoping study. We have a benchmark 10,000 tonnes per annum production, but the key numbers here are the NPV. NPV means what's this project worth right now if someone came up and wrote me a check? It's worth $1.3 billion in the ground as we sit now. And the other big number here is the operating cost, which is in the bottom left-hand corner here, which is in US dollars per tonne, which you'll see why in a minute. And we believe that we can produce high purity alumina at least 30 to 50% at a lower cost than anybody else globally. And if you recall, that's the fourth thing that has to be true about your deposit in bulk commodities to make it work. So we believe that's going to drive the value of this company very significantly. So I've been telling this story almost non-stop now for 13 months since we got the project. And finally, in the last month or so, we've actually got a bit of market love. We're at a 3-year high, 2.3 cents, 2.4 cents yesterday, significant volume going through. We released our scoping study in November. And like everyone, a lot of people obviously got hit hard late last year and the start of this year. That hasn't been the case in Impact. We're up sort of 70, 80% since the start of the year, because now the story is starting to get out that Impact Minerals might have its hands on something significant. Market cap's currently 60. We've spoken about the NPV, and so there is definitely significant upside that we're going to drive the value of this company towards over the next 2 to 5 years based on this project. And so you might want to look at this, because I gave this talk in March and that number was 33. So make sure that you get on the train. So this is the cost curve analysis. What this does, we sort of jump into the future and imagine that ourselves and some of our peers, Alpha HPA in particular, are in the marketplace, and we're looking at the costs of the current producers, which are Chinese and Japanese. They're very high input costs because these guys make their HPA out of aluminium metal, which has gone through, it's been mined as bauxite, gone through a very environmentally unfriendly, energy-intensive process called the Bayer process to get to metal, and then it's refined again. So very high input costs, $15,000 to $20,000 a tonne. Alpha HPA been extensively in the news recently, absolutely knocked it out of the park in the HPA business, and they believe that their costs of production significantly lower, and they've made a significant entry into the market. We believe that we can be significantly lower than even Alpha HPA, and that's going to drive the value for us going forward. So what is high purity alumina, I hear you all ask, and so it's aluminium oxide, various forms. It's corundum, it's sapphire, so it's very hard, it's thermally inert, chemically inert, and it's all about the purity. So 4 nines is what we talk about as a benchmark, 99.99% pure, so it basically has 100 parts per million of something else in there, and it's listed on the critical minerals list in Australia, Europe and the US, which is opening up avenues for funding for us through various grants, etc. So what is it used for? So for those of you who have Samsung phones, you're probably grateful that they're not exploding in your pockets anymore like they were a few years ago. And that's because HPA is used as a separator and coatings in lithium-ion batteries and other battery architectures. So it prevents the thermal runaway. Because it's thermally inert, very high melting temperature, it stops the heat going through the battery but allows the chemistry to flow through. So if that battery's not made properly, you get a peel away of the separator and the battery basically explodes. So the other main use, and probably the greatest use going forward, is actually LEDs, fairly mundane, but virtually all of the lights in here that are LEDs, they've all got HPA in there. And increasingly, we're seeing LEDs in screens. So those of you watching your smart screens, your LEDs, your OLEDs, your ULEDs, and increasingly your micro LEDs, you're all looking at HPA in that screen as sapphire. Huge demand growth for that, and we're seeing big buildings covered entirely in LEDs, like the LA Dome, if you've seen that spectacular building. Huge growth forecast there. There are also niche markets like sapphire glass, like you get on your Apple Watches, and increasingly across all of your tablets and all of your devices. So people talked about the lithium decade. It's possibly the HPA decade as well, and there's basically, this is just looking at supply and demand. It's been pretty accurate over the last few years. It's growing at 20% per annum. Most of the demand is coming in LED plus lithium-ion batteries, and the forecast sort of supply tightening around about 26, 27, probably as offshoring from China really starts to dig in. What's it worth? The benchmark 4N, as we spoke about, is trading between $15,000 and $25,000 per tonne. And so if you multiply that, so that's the average cost, call it $20,000 a tonne. This is where the volume is. It's in 3N and 4N in this space. There's some very good margins to be made in the 5N, extremely pure material, but there's no significant volume there. So we will be a low-cost producer, so we're focusing here straight away in the 4N space. How much of the alumina do we have? So we basically, you can round this up a little bit with a bit of extra drilling, basically almost 1 million tonnes of alumina that we can convert into HPA. So it gives us at least a 50-year mine life. Again, one of the characteristics of a world-class mine. And as a result, if you multiply 1 million tonnes by average $20,000 a tonne, you get an in-ground value in the billions and billions of US dollars. Where is it? It's 500 kilometres east of Perth in the middle of nowhere, and this is what it looks like. It's a lake system, but these two salt lakes contain that resource. The lake itself is only 2 metres thick of sediment, and then you're on rock underneath it. And there's a couple of man-made advantages here, is that there's actually a fire break that's been graded in right to the edge of the lake, and this will actually be the haul road, so no significant clearing required to even get to the deposit. This is Roland Goddard. He found the deposit for a bit of lateral thinking, and this is how we drilled out $20 billion worth of material. We used a rubber mallet and a plastic push tube, and it cost a total of 60,000 Australian dollars to do all the drilling and all the assaying. That is the best return on a drill program you're ever going to see. And this is what it looks like when it comes out. It looks like plasticine, and it's incredibly fine grained. So it's naturally mostly less than 1 micron in dimension. It's nanometer scale particles. And for those of you who remember physics, that actually gives us an infinite surface area almost in this deposit. So what it means is that when we drop it into the reagents, it just goes straight into solution. So how are we going to mine it? We're basically just going to come in off the side of the lake, mine the high-grade material, and stockpile material every 3 years and just truck it off-site. So there's going to be no on-site processing. So compared to conventional mining, there's no drilling, blasting, crushing. We don't need water on site. We don't need power on site. We're going to leave a hole in the ground that's probably only going to be 1 to 2 metres deep maximum. And from our initial trial pits we've already done, the thing fills in as the clays expand. So the long-term environmental liability here is about as close to zero as you can possibly get. So no long-term mine closure issues. Environmental surveys have already been done. Baseline, there's no significant issues on the lake. And very importantly, we've got heritage clearance from the RIU peoples. They're based in Norseman. They've already got a significant royalty from the RGO Nova Bollinger mine. Very pro-mining. We'll be in an agreement negotiations with them over the next 12 months. I'll be spending quite a bit of time in Norseman, socialising with the family groups down there. And we'll look towards getting a mining agreement in place towards the end of next year. I won't dwell on the process, but the fact that it is fine grain gives us some very unexpected reaction kinetics that aren't supposed to happen, but we can see it happen on the desktop and the bench top. Roland did most of the experimental work on these processes on his kitchen bench top, so his wife was certainly glad when we came along with a joint venture and took it into the laboratory. And you can actually make the precursor to HPA with a slow cooker. And so we're going to keep your eyes open for a video that we're going to do on how to make HPA. So that'll be an interesting one when we get it out. So we're in the middle of a pre-feasibility study, which is on schedule to be finished by the end of this year. We've got metallurgical test work, that's the key thing. So at the moment, we're optimising the 2 processes that we have to produce HPA, and that will then be a key pillar of the study. Which one of those will we go forward with? The second one is mining approvals. So in discussions now with the RIU, we're ready to lodge a mining lease application because of all the advantages with the environmental issues that I've spoke about. We believe that we can get this mining lease granted in a very short period of time, hopefully by the end of 2025. One of the big things in the scoping study that we didn't really have an answer for is where are we going to build the process plant. As I said, we're going to truck this off-site, which will make the approvals process on-site for the mining much quicker and easier. Similarly, if we build the plant in a registered and recognised industrial yard, that will also make it easy to permit. So it looks like Kwinana will probably be the go, and that will be one of the big outcomes of the PFS. But the big one, and this is one of the things in bulk commodities, is that you need to have offtake partners. And So that's going to be the big task for us in the back end of this year. We will have plenty of material that we can hand out to potential customers. There is no shortage of demand. Let me tell you, we've knocked on a few doors, and the first thing everyone is asking for is, please send me some product. We want to get in there, especially as they can see from our work that we might be able to undercut many of the other competitors in the marketplace. So that's going to be a massive thing for us to build out over the next couple of years. I talked about billion-dollar market caps, not worth getting out of bed for anything less. This is a story of Alpha HPA 4 years ago. They were a junior explorer, Colorina nickel or Colorina cobalt. Came across a new process for HPA production, $20 million market cap, currently sitting at around about $1 billion. This company is an absolute textbook example of how to run a fantastic company. If you get it right in the HPA space, this is where you can go. I believe that we can follow in their footsteps. They've shown that it can work, and we aim to be the next one off the rank. So Impact listed in 2006. As I said, it's been a long journey looking for a world-class ore body. I believe that we've got one. We're absolutely flat out trying to make that work. We've had this big run on the share price. We actually acquired the project back here in March. It's only been 13 months. We've probably caught up all of the other competitors in terms of where we sit, in terms of our feasibility studies, engineering studies. Probably overtake them, we think, next year. Very strongly supported by 2 German groups, Family Office and ABC, which is Deutsche Balaton, a well-known resource fund investor in Australia. So had a great year last year, but this year it's all about completing the PFS, getting those samples into customers. We will probably trigger an early build of a pilot plant, give us plenty of material for our qualification trials 25, and really looking to get a demonstration plant built at about 1,000 tonnes per annum maybe. That's the thing we're thinking about, and that's about the time that the supply tightening should come in. So hopefully we'll get our timing right for some good prices on our first batches of HPA. So that's it. We want you to come on the journey. We aim to be one of the lowest cost, if not the lowest cost producer of HPA globally. We've got a unique deposit in a tier 1 jurisdiction, cost disrupted metallurgical process. We're full on in the PFS. We're building out our capabilities in metallurgy and the final product specifications, and we hope to deliver into a high margin growth market with significant upside potential over the next couple of years. So please come on that journey with us. Thank you very much.
Goal today is really to get everyone to understand exactly what this lithium conversion gap in North America is all about. And I think I'll get to that point pretty quickly. In terms of the lithium supply side, in Quebec, there's over 40 companies that are working to probably build out circa greater than 500 million tonnes of greater than 1% lithium. These are now household names. We've got Patriot Battery Metals, we've got Winsome Resources, Allchem James Bay, and Siona, just to name a few. On the downstream demand side, we've got over 20 different battery manufacturers now in North America. So these include General Motors, Ford, Northvolt, and Tesla. So by 2028, we're expecting that there'll be in excess of 1,000 gigawatts of battery or cathode capacity in North America. In turn, this will require in excess of 850,000 tonnes per annum of lithium chemicals. Now, current conversion, you're looking at 95% of current conversion happening in China. So you've got spodumene that's exported into China, and then these battery manufacturers, they'll import back the lithium carbonate. Interestingly, at the same time, North America has been very open about its attempt at decoupling itself from China. Now that leaves the continent in a very sort of delicate situation because there are no operating converters in North America. In fact, planned conversion capacity is only 100,000 tonnes per annum by 2028, and all of that spoken for. So you've got a requirement of 850,000 tonnes per annum, but planned capacity of only 100,000 tonnes per annum. And that's only 4 years away. That's the lithium conversion gap. And introducing Lithium Universe Limited, closing the conversion gap in North America. So there are a number of issues with filling this conversion gap. The first is that lithium conversion, it's a complex chemicals business. There have been many failures, a lot of companies experiencing significant technical difficulties, even amongst existing lithium producers. It takes years to establish operations and ramp them up to the point where they're commercially viable. And you need a proven team with real expertise. We have that proven expertise. We have proven technology. So the executive chairman of our company is lithium trailblazer and experienced lithium operator, Mr. Iggy Tan. Iggy ran Greenbushes Lithium in 1995 and was the first to commission a lithium carbonate plant in Australia. He was also the first mining executive with an eye on the lithium-ion battery future some 25 years ago now. Iggy and his team built Mount Cattlin, rated at circa 137,000 tonnes per annum, and they also built the Jiangsu lithium carbonate plant in China, rated at 17,000 tonnes per annum. When Iggy first joined Galaxy, their market cap was less than $10 million, before he put them on a path to ultimately exceed $2.5 billion on merger with Orocobre. Galaxy is the first large-scale integrated mine-to-refinery project of its kind. Joining Iggy on the board is Greenbushes veteran Mr. Pat Scallon. Pat ran Greenbushes for over 25 years and oversaw a production increase from 200,000 tonnes to in excess of 1.4 million tonnes per annum. We've also been joined by Dr. Jinwan Liu. So Dr. Jinwan Liu is former Galaxy. He's a world-renowned downstream lithium technology expert. There is, I don't think, anything he doesn't know about this space. And most importantly, Dr. Liu designed and commissioned Jiangsu with Iggy and the team. Rounding out our lithium dream team, we've got the former GM of operations at Galaxy, Mr. Terry Stark. We've got Roger Pova, who ran Mount Cattlin. We've got Hui Ning, who built Mount Cattlin. Even John Loxton, he was there building Jiangsu with Iggy and Jinwan. He's on the team. And our most recent appointment was the former CFO of Galaxy, John Zabolski. So in a very short period of time, we've put together a team that designed, built, financed and operated difficult projects in difficult markets. If we step through a typical lithium mine development timeline, it looks something like this. From maiden through scoping, PFS, DFS and funding, typically takes 8 to 10 years. If we compare this to what the Dream Team achieved at Mount Cattlin, from maiden to first product, inside an astonishing 3 years. They achieved this by skipping scoping and PFS stages, running a number of other processes in parallel, all whilst leveraging an incredible team culture. And here is Mount Cattlin. Million tonne per annum hard rock spodumene mining operation, leveraging 4-stage crushing into dense media separation to produce circa 137,000 tonnes per annum. If we turn our attention to what's happening at the Tanchi Kwinana lithium hydroxide plant, despite commencing construction in around 2016, they're reportedly still only operating at 8 to 10% of design. That's 8 years later. Capital cost blowouts have been extreme, to the tune of almost $400 million. The story at Albemarle's Campbellton plant is no different. Lengthy construction period, lengthy commissioning period, and still only operating at less than 50% of design. Most recently, they've had to parachute in Chinese operation expertise to help fill that gap. And if we turn the page to Canada, the story stays the same. North American Lithium commenced in 2014, and after spending in excess of $250 million and producing only around 110,000 tonnes lithium carbonate, filed for Chapter 11 in 2015. Nemaska Lithium completed their DFS in 2018, and despite spending in excess of $400 million, failed to reach startup by 2019. So why have some of these projects failed? We've identified that it's a lack of operating direction at design. There's a limited amount of management oversight, and there's limited commissioning expertise. This is one of the core reasons why our Lithium Dream Team are all operators, and it all starts at design. Compare those aforementioned projects what our team achieved at Jiangsu. From breaking ground through project completion and commissioning, a short 25 months. Capital cost was a more than reasonable $120 million. It operated at design rate all to us delivering the highest quality lithium carbonate in the world. Here is Jiangsu. And as Iggy alluded to earlier, Jiangsu, when it was built, was the largest of its kind in the world. Jiangsu was a Western-style continuous processing plant, which to this day remains the gold standard for quality process control in China. It's currently operating at above nameplate, 20,000 tonnes per annum. Now, whilst both these projects have since changed hands, it's important to note that they were designed, built, commissioned at a time when lithium prices were a fraction of what they are today. And this speaks volumes to our team's vision, foresight, and ability to deliver difficult projects in difficult markets. We've also seen that Canada's forcing a downstream solution. This is evidenced by Sinamine's forced divestiture from Power Metals Corp and relinquishment of their spodumene offtake agreement, citing a multi-step security review. Canada also has, unbeknownst to most, a burgeoning EV market, with an automotive industry which exports in excess of 1.6 million vehicles annually. It's clear that the government's forcing a downstream solution. Our solution to help close this lithium conversion gap is the Quebec Lithium Processing Hub. The Quebec Lithium Processing Hub is a mine-to-battery-grade lithium carbonate strategy where we'll leverage a 1 million tonne per annum multi-purpose concentrator feeding a 16,000 tonne per annum lithium carbonate plant. The lithium carbonate plant will be based on the proven Jiangsu design. Any battery-grade carbonate will be sold into North American markets, which will meet the Canadian government's critical mineral strategy. More importantly, it'll also offer that downstream solution to the Canadian miners like Patriot and Winsome and Sayona that we referenced earlier in the presentation. We've engaged Hatched Engineering to complete the engineering study for the refinery. It's a DFS level of study, and they're currently working to identify what the long lead items will be and also what the capital cost will be to replicate the proven Jiangsu design, but for the Canadian environment. Here's the process flow for our refinery. Not typical to see this published, and speaks volumes to our team's confidence that they're on the right track. I've highlighted the purification flow at the bottom to show the production of battery-grade lithium carbonate. We often get asked why carbonate over hydroxide. Well, our team has a proven track record in carbonate. Carbonate is also the feedstock for LFP batteries, and there's been a move to LFP batteries. Tesla last year announced that they're moving to LFP, citing improved safety and reduced costs. We've also seen that there are a number of Chinese producers who are moving to switch from producing hydroxide to carbonate. We've also completed our lithium refinery location study in conjunction with Hatched. Settling on the Bécancour Industrial Park is our preferred location. We've signed an option over land in that park. It's the perfect choice. Proximity to sealed roads, rail, and deep water port. Our design incorporates an initial train of 16,000 tonnes per annum per the Jiangsu design, but we've retained additional optionality for a further 2 trains to bring total capacity up to close to 50,000 tonnes per annum, allowing us to make a real dent into that 750,000 tonne per annum conversion gap we identified at the top of the presentation. And as if we're not doing enough, we've also commenced the carbonate refinery test program. Under the watchful eye of Dr. Jinwen Liu, we're conducting MET testing on multiple sources of spodumene from around the world. This will allow us to build a really robust refinery, but also allow us to import ore from anywhere in the world and have it processed at our refinery in Bécancour, while allowing the Canadian market to continue to mature. So in summary, we've got the Lithium Dream Team, a proven management and board team that's delivered difficult projects on time and on budget. We've got proven technology which will help close the lithium conversion gap in North America, and we've got the Quebec Lithium Processing Hub strategy. So there's no better time than now to join us on our mission to help close the lithium conversion gap in North America. Thank you.
I've titled the presentation Breakthrough Mineral Discoveries in Eastern Australia, but it could easily be titled a unique exploration company, because we have some features about us that are fairly uncommon amongst explorers in Australia. We have three assets, two exploration assets and a financial asset in terms of the iron ore royalty that we receive from MinRes that funds 100% of our operating cost and our exploration cost. The front runner exploration asset is a project called Durnings in this Lachlan project in New South Wales at south of Cobar. And I'll talk in much more detail about Durnings, which was the most recent discovery, but there are a number of discoveries up and down that eastern side of the Cobar Basin that we have exposure to. But before we get on to that, a bit of corporate overview. Small number of shares on issues, 188 million. We have $7.6 million cash today, but that varies somewhere between 7 million and 10 million because we receive our monthly royalty check from MinRes. Zero debt, and the board and management have the DNA of Jubilee Mines within it. Kerry Hamanis is the largest shareholder and the chairman. Brian Dawes, Jeremy Kirkwood, both involved with Jubilee heavily, which that team of people took Jubilee from about a $50 million explorer into a $3.2 billion sale over about a 5-year period on the back of Australia's highest grade nickel discovery at Cosmos back in the early 2000s. So there is precedent here within the team, and the aim here is to make Talisman Jubilee number 2. The financial asset, as I mentioned, MinRes run the Wonmunna and Iron Valley iron ore mines up in the Pilbara. We receive a 1% gross royalty on iron ore sales. Wonmunna makes about 60% of the 10 million tonnes of export that MinRes do out of Pilbara on these two projects. So we're receiving about $1 US per tonne of iron ore that comes out of Wonmunna at a 1% royalty rate, when the iron ore price for 58% iron is about US 100. More recently, it's been US 110 to 115. So as you can see on the bottom of the slide there, the royalty payments in the March quarter were 2.5 million. So we're pushing somewhere between $8 and $9 million worth of payments this year, a little under 8 million last financial year. So it's a very significant asset for us. The current ore reserve on Wonmunna is between 4 and 5 years, but there is a substantial resource pushing 80 million tonnes lying behind that MinRes will bring to account over this next few years. They've just started this last quarter some drilling programs to convert some of that resource to reserve. So we're considering that this is somewhere between a 5 and a 10-year life asset for us. Lachlan project. We've owned it for about 4 years. 2021 and 2022 were very, 2021 was COVID, 2022 was rained cats and dogs here in New South Wales, so it was very tough to get on the ground. We did a whole raft of airborne geophysics over that time period, over the entire tenement holding. So the work that we did then is now starting to bear fruit. We've been exploring on the sort of the yellow projects highlighted in the southern half of the project area. Made 2 discoveries in this last 12 months at a project called Rip and Tear, and the most recent one is the Durnings project right at the southern end. But it's a 6,500 square kilometre tenement package, and we've really only just started the on-ground work on about 1,000 or 2,000 square kilometres. So there's a long journey ahead of us for assessing the rest of that tenement package. Durnings itself, Durnings sits on about 300 square k's of ground south of the Mineral Hill mine run by Kingston. We have the lion's share of the ground holding over that particular block of ground, so we feel like we're in a reasonable position. the very first hole we drilled into Durnings, which was about 18 months ago, got 8 metres at 6.3 gold and 0.7 copper and a sniff of zinc and lead and silver. So the geologists started to get a little bit interested at that sort of stage. We followed that up back in October with another 6 holes. Hole number 6 in that program hit a high-grade zone that I'll point to. It was 42 metres at 2.3% lead, 1.3 zinc, some silver at 0.43 gold, so a reasonable intersection. So the geologists started to get a little bit more excited, and particularly in the bottom of that hole, we hit 6 metres at about 15% lead and zinc combined, 126 silver, 2 grams gold. So the geologists are really starting to get a bit hot and frothy at this stage. Fast forward to March this year, we've just completed a 24-hole program over that geophysical image, assessing what that gradient array IP shows us, and gradient array IP is used for detecting near-surface sulphides because they're nice and chargeable. The hole number 6, as you see on the slide, which is on the left-hand side of the picture, intersected that high-grade zone at about 250 down hole. We drilled another 4 or 5 holes on that section. Hole number 19, which is drilled back in the opposite direction. Hole 19 here comes down here. We discovered the high-grade zone, or rediscovered the high-grade zone, confirmed it. Got 7.4 metres at about 10% lead and zinc, 137 silver, sniff of copper, sniff of gold. Included in that was a 1.7 metre massive sulphide zone, running 26.5% lead, only because we hit the upper limit of the assay method that we were using in lead. So, there were a bunch of 40% lead intersections in there. 9 ounces of silver, 0.7 copper and 0.81 gold. So the geologists are getting very excited at this stage. But that hole pushed on, and just before I go on, so that's what that material looks like. The massive sulphide in here is 100% galena and sphalerite, so that runs about, both of those zones went more than 40% lead. So this is the typical type of style of mineralisation that you see in this Cobar Basin. They typically have relatively small footprints, but have lots and lots of depth extension. Cobar Mine as an example. Moving on, there's a couple of pretty pictures of the textures in the core. But we pushed that hole on to 453 metres, hit a second zone of mineralisation that was rich in gold. 28 metres at 4 grams gold, percent copper, 5% lead and zinc combined, and just under an ounce of silver. And within that, there was a 10-metre zone that went 8 grams gold and 1% copper and 11.5% lead and silver combined. So, what comes after hot and frothy for geologists? Well, I'll leave that to your imagination. That's what that core looks like. So it's rich in chalcopyrite. There's less lead and zinc in it, and it has unusual textures for that style of mineralisation. So it's a well-known style of mineralisation called low sulphidation epithermal, but it's in a very unusual spot for this Cobar Basin. So the kind of things that we are now thinking about is, well, we just haven't found a deposit here. We've found a mineralised system, and the mineralised systems are the holy grail of exploration for exploration geologists and companies alike. So very interested to develop this further and get a whole bunch more work done in this particular location. Next steps, as I mentioned, we drilled 24 holes. We're still waiting on assay results for the final 12 of those. And we've been out in the field doing downhole EM, which was mentioned by one of the earlier speakers as a good technique for finding massive sulphides. The downhole EM should light up with these massive sulphides particularly well, and should light up with the epithermal vein style mineralisation because it's high in chalcopyrite. So, very conductive material, and we'll see what those downhole EM results look like over this next couple of weeks. all the results of these next 12 holes should be in the market in the next 1 to 3 weeks' time before we go back and have another follow-up drilling program associated with what the chargeable plates will show us in the downhole EM, and we've obviously got a raft of infill work to do based on where the best grade is in the system as we see these 24 holes. The other thing that you look for if you think you're onto a mineralised system is there evidence elsewhere in the surrounding ground of similar look-alike kind of projects. You'll see on the right-hand side the drilling has been done on 2 relatively small chargeable anomalies where the yellow dots are. There's a very large one to the east of us that we haven't done anything on other than take some soil geochemistry over it. We're still waiting on those soil geochem results or auger geochem results, so looking forward to seeing what those look like, and we'll refine the targets on that project in the back half of this year. But at the moment we've kind of got our hands full just dealing with what we've found so far at Durnings. We've also pegged a block of ground to the south of the block that we already owned, which happened to be vacant. So we now have about 25 linear kilometres on this project, up from the 15 that we had previously. And again, looking for mineral system indicators, we have another project that's about 10 kilometres to the northwest of the Durnings discovery. It was drilled by us back in 2020, 2019. It's got some high-grade copper numbers in it. I don't think we really understood it at that stage, and we're re-evaluating that in the context of what we find at Durnings, particularly with the higher grade copper gold material that we've found. But there's some impressive numbers in this blind calf project, a series of 5 metre to 20 metre intersections at somewhere between 2% copper and 5% copper. So some really nice numbers, but we're still unravelling what that might mean for us over the longer term. This is more high-grade copper vein style mineralisation. Again, relatively small surface expression, 150 to 200 metres at surface where the old workings are, but lots of continuity down dip and down plunge. So we'll go back and re-examine that in the light of what we find at Durnings. Further to the north again, this was the Rip and Tear project. It's about 25 kilometres north of Durnings. It's a large, low-grade silver and lead deposit, or silver and lead discovery. Typical intersections are somewhere between 80 metres and 200 metres of continuous mineralisation, but it is low-grade. It's 1% lead, 10 grams silver. We'll see how high, wide and handsome Durnings becomes before we go back here and reassess what this might add to Durnings if we can prove Durnings to be a high-grade significant deposit. So in summary, I said we were somewhat unique. I think for juniors to have a $8 to $10 million royalty stream that funds everything that we do is a very unusual situation for mining companies, or for junior explorers and mining companies alike. We feel as though we have a team that has a track record. If you were a shareholder in Talisman 5 years ago, when you bought at 10 cents, you would have received 22 cents in capital return, a 5 cent a share tax credit in addition to that, and you'll be sitting on a 28 cent share as we are today. So there's been about 40 cents of value added over that time period, over 5 years, so that in anybody's language, that's a pretty reasonable return on a 10 cent investment. Chrissy, I'll leave it there. Thank you very much. And just before I go, if you're interested in getting a little bit more understanding of what we've got at Durnings, then we are at the very far end of the exhibition booth, just in front of the coffee stand. And thank you for your time and your attention.
Thanks, Chrissy, and thanks, RIU, for inviting us to speak today, and thank you for your time. Look, the two main executives in Firebird are manganese obsessed. I think Wei is up the back there somewhere wearing a Firebird hat. Wei has extensive manganese experience on the battery side. I've worked in manganese for some 24 years. Some people say it's a bit tragic, but once you get into it, you just can't let it go. So really, there's 4 key messages I want to leave you with today, is that Firebird is a bit of a unique manganese play, where the rest of the world is kind of looking to diversify away from China. We're looking to go back into China. And that gives us a number of advantages. You know, we look to be the lowest cost manganese sulfate producer in the world, not just in China, but the world. You know, we see extensive demand coming on stream, not only from all lithium batteries. You know, manganese is in nickel lithium batteries, it's in lithium iron phosphate batteries, it's becoming lithium manganese iron phosphate batteries, it's in solid state batteries, it's in sodium batteries. So wherever you look in batteries in the future, manganese has a very key role to play, and we see that we want to leverage that demand. So, you know, and part of that is we're developing 2 development streams, the sulfate plant in China and then our own resource in Oakover in the Pilbara in Western Australia, and both are equally as important. And as we kind of mentioned, the 4th point is we're very experienced in manganese. So just a vision on how to capture an image to capture that vision. So on the right-hand side is our mining. You know, Oakover is a large resource, near surface, low strip ratio, very simple processing mine, and we're working our way through developing that. Simultaneously, we're working on our battery strategy, and stage 1 of that is building a manganese sulfate plant in China. That will be fed initially by third-party ore, because we see that China has the ability to accelerate and give us speed to market like no other. So that will be in production before our mine. But we will look to feed the mine feed from Oakover into stage 2 and 3 of our developments in sulfate expansion. A little bit about a feasibility study we announced yesterday. So this is looking at producing about 70,000 tonnes of manganese sulfate equivalent, 50,000 tonnes of battery-grade manganese sulfate, or 10,000 tonnes of manganese tetroxide. From that, our capex is, I think, world-leading in terms of US $83 million for the project, working capital of US $10 million, but most importantly, well, that's very important when you compare it to our Western peers. You know, our capital intensity is approximately a quarter to 30% of Western manganese sulfate projects. On the OPEX side, you know, we're forecasting an OPEX of just over $600 US a tonne at $609. When you compare that to other producers in China, the graph in the top right-hand corner, you see because of the IP, because of the patents, because of the technology we've acquired in China and the process and what China can deliver us. You know, we have 2 phases, a saving because of process, because of engineering, and because of the IP. And so that puts us in really good stead. You can see benchmark forecasts the 2 other costs on that curve, and we're considerably lower than that. We recently, 2 weeks ago, took some financiers and investors to China to visit visit our site. We built a pilot plant there. You know, we have done this in record time. Like we commenced pilot plant construction or fit out in November of last year. It was running in end of January. It's now producing battery-grade manganese sulfate and manganese tetroxide. I think the real key for this visit was it was eye-opening for our financiers and our shareholders of what you can do in China when you have the right support. And we have the right support. We have the government, so we're looking to build in Jinshe in Hunan province. And Jinshe local government is incredibly supportive. We've got very good land rebates, we've got very good tax incentives for the first 6 years of our project. And that was clearly demonstrated to our investors. We also then went and visited a lithium hydroxide plant. And the reason we did that is because our largest single shareholder, a company called Canmax Technologies, is joint venture partners of the Mishan lithium hydroxide plant. And previously, speakers have been talking about the costs of building lithium hydroxide plants. Canmax built the 60,000 tonne plant in 7 months, commissioned it in 30 days. It's run to full capacity ever since. They are 9% shareholders of us, very close connections to CATL and other big battery producers in China. Just a bit of a timeline. So we've announced our feasibility study. Simultaneous to doing that, we've been doing engineering and permitting. You'll see our permitting is very well advanced. In the next few weeks, we will, probably by the end of this half, we'll be announcing an update on our permitting. So package that all together, with financing, we could find ourselves in a position of financial investment decision by the Q4 of this year, and then a 12 to 15 month build. So theoretically, we could be in production by the end of next year. So just a little bit about manganese. We won't stay here too long, but like I said, manganese is used in pretty much all battery cathodes, and it's growing in its importance. If you look at the bottom right-hand corner, there's like the blue bits, it's a statistical representation of the amount of manganese in a type of cathode. You can see the new emerging manganese-rich cathodes in nickel cathodes, like 307s and NMX, where, there's literally twice the amount of manganese required in those cathodes. But what we're really excited about is, in China, specifically, LFP-style batteries have really taken over nickel-based batteries, but LFP is now also being improved, and they're now adding manganese to make lithium manganese iron phosphate, or LMFP. And we see forecasts that LMFP will replace 50% of LFP by the end of this decade. We also see forecasts that LFP will be approximately 15 million tonnes in China by the end of this decade. So if you convert, say, 15 million tonnes, half of it going into LMFP, the conversion into manganese sulphate demand is almost 0.8 of a tonne of sulphate to every 1 tonne of LMFP. So we see that. So if you do all that maths, it's like at least 10 times growth from where the current market is today, and hence why we want to build this sulphate plant early. We see it as a very low cost base. We will have a unique position and advantage in the market. Oh, and all the companies on the right-hand side are involved in LMFP already. So like from Tesla to Goshen to Dynonic, all the way through the battery supply chain, LMFP is there. It's today, it's not coming in the future. LMFP is not really new technology. It's been around for about 10 years. In China, they were incentivizing nickel-based batteries for many years. The government was subsidizing nickel-based batteries for many years. Once that subsidization fell away, LFP has taken over, and now 70 to 80% of all batteries in China are LFP. And again, that conversion from LFP to LMFP is what we see is really going to drive demand, and we get really excited about. So my colleague Wei Li has done a fantastic job in China. We've recruited some of the best technology gurus in China. Mr. Zhou, he's now an employee. He's our COO of our Chinese subsidiary. He's had 20 years experience in manganese sulphate. He had a number of IPs and patents over not only the process, but over the engineering as well. He has a team as well that he's brought in with us, and we've now got a high quality, world's best team in China. So offers a huge amount, and what you see in our OPEX and our CAPEX is because of the team we've assembled. It's very reflective. So along the way, we'll be the first foreign entity to build in Jinshe Chemical Park. As I said, the local government there is extremely supportive. The Chinese government as a whole is very supportive of foreign investment. We've had nothing but support for as long as we've been doing this. And another layer of that is we've been entered into a cooperation agreement with China Chemical. China Chemical is a very large conglomerate in China. It builds mainly chemical parks and chemical factories. It's built something like 90,000 chemical factories over its 70-year life. All chemical factories in China have had China Chemical involved, or maybe 90%, I should say. So they are very keen on supporting us. There's lots of synergies involved with China Chemical. They actually built Jinshe Chemical Park. They actually maintained Jinshe Chemical Park. And we look at how we can leverage the synergies between ourselves and China Chemical in the future. So just a little bit why we chose Jinshe, why in Hunan. So Hunan is the little red province that's marked out on the map. We see that area is very important in China. Hunan and the surrounding provinces, I think today Benchmark Minerals forecast is around 26% of the world market, of the world's gigafactories. By the end of this decade, it's growing to 27%. It's significant. I think if you put USA and Europe together, they would still be smaller than that area in China. What I haven't mentioned is the benefit of being in China is this like circular economy, what I call it, where everything feeds into another process of the plant. So, you have a chemical park, all your reagents are nearby, all your acids are nearby. And what's even more important, all your residue can be consumed by another process within the chemical park. So like our residue all gets fed into concrete production. So we have a process that is zero waste, very environmentally friendly. But we see huge amounts of demand. We've sent our guys out, and with a 150k radius of our plant, there's about 3 million tonnes of LFP production existing. So again, if you use that conversion factor, 1.5 million tonnes ends up in LMFP, and then you convert that to manganese sulphate demand of 1.2 million tonnes. Our 50,000 tonnes is a drop in the ocean compared to the demand just within 150 k's of us. So this is Jinsha Chemical Park, nice aerial photo that's got its own port. There's 100 companies already built and existing in the chemical park. Very well run, very modern, very good safety standards. Building a project in China, safety is number one, very important. Lots of processes that we need to go through to get our permits into play. It's on the banks of the Lisha River. The Lisha River connects to the Yangtze River. Yangtze and river transport is one of the cheapest ways to transport goods in China. So we have a real advantage of, as I said, all reagents, all acids, all consumers of our residue nearby, our customers nearby. All of this works together to drive a very low capex, very low opex. So this is a couple of pictures of our pilot plant. We're producing up to 10 kilograms a day of manganese sulphate and a few kilos of manganese tetroxide. It's great. We've had our first European OEMs come and visit us in our pilot plant. We're getting lots of interest from cathode manufacturers as well. Great way to demonstrate our ability, our technical nous to how we go. So this is our process. We won't dwell too long here, but if you note the cream areas that are highlighted, they are the real areas that are driving our cost production. So, in one form, the MVR crystallisation, what we have got is, through Mr. Joe, the 5th generation, it consumes about 8% of the energy of the original. So a number of the other Chinese peers are using the 3rd generation, and, so we've got a great advantage over that for that. We've also lodged a patent for our calciner. You have to reductive roast the product as it goes into the feed. A lot of energy has been wasted in traditional models. We've designed, or Mr. Joe and his team and Wei have designed a way of capturing the heat, reusing the heat, which we think will use about 1/6 of the energy of conventional models. So Oakover, just quickly, I know I've only got a minute to go. 85 k's east of Newman. It's a large project, large resource on surface. The most important thing, people say it's low grade. It is low grade, but the most important part is it's 40% silica. That silica is easily washed out through mechanical beneficiation, pulls the manganese grade up to 32%, becomes very saleable. Just one last point is on Oakover, we did a scoping study last year, producing 1.2 million tonnes a year for 18 years, impressive NPV of $740 odd million, great IRR of 73%. That will feed into our future plans and is very important. Board, 142 million shares on issue, very experienced in manganese. How about that with 7 seconds to go?
Thanks very much, Chrissy, and thanks very much to the organisers of this conference. I mean, it's a great conference for us coming over from the West. Gives us a chance to see our East Coast investors, and yeah, it's a great conference. Anyway, I'm moving on. Auroran Resources. Look, we've previously a gold explorer with projects in Kalgoorlie. We made a strategic decision mid last year to go to Brazil, basically to look for spodumene and lithium. We see that as a great opportunity for our basically investors, and as part of that, we've identified our spodumene zone at a Boca Rica project, and we've started diamond drilling now. I'll talk a little bit about that. And look, we've also picked up some niobium ground there. I was sort of personally very excited about that, and basically it's open tenure. So that's basically an exploration opportunity that we see a lot of upside on. And as well, we've got our West Australian gold projects, which we haven't forgotten about, so I'll talk about them too. So just on our corporate structure, it's a fairly tight share registry. I'm probably the major shareholder. On our board, we've got Jeff Williams, he's a mining engineer, basically ran mineral deposits and took that from a 30 million market cap up to over $1 billion. I worked with Jeff at McPherson's Resources for over 10 years, so during that time we took the Barara resource from 60,000 ounces to over 500. I oversaw the BFS studies for that, as well as I was a mine manager, so I took that into production. It's great to see the rise and restarting mining there shortly. And we've got Andy Tudor, who's Managing Director of Nexus Minerals, and Steve Hewitt and Dutton. So why did we go to Brazil? Well, look, I just thought Brazil was a fantastic mining jurisdiction. Obviously, BHP and Samarco have been mining iron ore up there for a long time. And we've seen some West Australian lithium explorers up there in the form of Latin Resources. So, look, they've done really well and they're looking like getting into production shortly. So we just saw that as a great exploration opportunity. Obviously, you know, like it's excellent infrastructure, there's hydropower there, good road networks, and it seems to be a great mining jurisdiction to work in. As I said, I've spent a fair bit of time there looking around at opportunities. So we started down the southern end of what we call Lithium Valley, and around this town called Governor Valdez. It's got a population of around 300,000 people. And look, I've done extensive fieldwork there myself. I've been there for 143 days since August last year, and basically looking at over a 6,000 kilometre square area. I've visited over 100 pegmatites operating mines, basically looking for LCT pegmatites and sort of getting a really good understanding of the geology of the area and what opportunities I see there. So we've basically set up an exploration team. It's led by Sergio Cardoso dos Santos. He's had a background in granite mining and underground mining in Brazil. And look, without someone like that, it's really hard jurisdiction to work in. So we need, you know, those people. We've set up a good team. We've also got a business development headed by Dr. Joe Hippett. He's a structural geologist. He's worked with Australian companies in Brazil for a long time. He's a Brazilian guy. He was a professor of the university there. So look, we've got a great exploration team, and that's sort of basically helping us with our strategy moving forward. With Boca Rica, look, we've looked at a lot of projects. We started off with the Jamie project. Unfortunately, we just couldn't get that to fruition, so we've moved to the Boca Rica project. What I liked about this is its officer scale. At Jamie, we had 200 hectares. Now we've got 3,800 hectares. The pegmatites here are a lot more extensive. The one we're currently drilling extends for over 1.7 kilometres. So I actually thought if we're going to find a project that's going to build, we actually need that scale, and I think this is what this gives us. And look, obviously, we've looked at these LCT pegmatites. They're, like I said, they're strike extensive, and look, we're really excited about this opportunity. We were impacted by the weather over there. Governor Valdez was hit by a 1 in a 50-year storm when I was in there in January, and it just rained and rained and rained and rained for 50 days, so we just couldn't do anything, and we've only been able to get onto the ground probably in sort of April, so that's sort of held us up a fair bit, but we're moving forward now. We've started diamond drilling, so we've got our company-owned diamond rig, so that was one thing I did last year. My sort of background has been, we run a drilling company in Australia here, so we just thought we need the flexibility of having our own rig, and it was quite a lot of work to set it up, to actually get the wireline drilling working properly and everything, but now it's running. Look, it's fantastic. So we started drilling our first hole, so I was personally really excited about that milestone. I know it's not a big deal, but for us to get started over there, it's been quite a lot of work, so I think going forward things are going to be a lot more easier. At the Boca Rica, we identified basically a 6 metre wide zone there where we're seeing these quite large spodumene crystals. So we just thought, right, this is a fantastic target, so we'll put our first hole here, and obviously we've started that drilling. So sort of moving on, like the other aspect of the Brazilian strategy was we've been looking at this niobium rare earth space for quite a while. I looked around Australia here for opportunities like this, and as it turned out, we were able to peg a lot of tenure in Brazil. So we've pegged over 50,000 hectares there. And basically we've pegged 2 project areas, one called Catalaya and one called Saltaire. And both of them host very significant niobium and phosphate resources. At Catalaya, I think that's the second largest niobium mine in the world, operated by the Chinese. I was actually quite shocked that all the ground around these operations was vacant. And when I started looking at Google Earth and doing some more work on this, basically you can see quite a few circular features there. So I've identified 4 of these circular features that to me look like potential carbonatite intrusions. So I'm really excited about this. We've only just pegged this tenure, but we're expecting it will get granted within the sort of next 2 months. I'll be back up there in about 4 weeks' time. I'm going to start field work on this, start some basic soil sampling and rock chip sampling, which we can do without it being granted. The other area is about 70 kilometres away, and that's called the Saltaire carbonatite complex. And again, it's a host to significant resources. There's actually resources there of over 900 million tonnes of phosphate and niobium here. So again, we've located 3 of these circular features on the tenure adjoining, as well as I've got a paleo drainage model. So part of my work back in Australia was doing regolith. I've done a lot of regolith work over the years, and it sort of looked a bit of a no-brainer that there was a drainage system that's coming off these carbonatites and going into this tenure that we've pegged. So there's a paleo drainage sort of laterite profile there. So that's one of our targets that I'll be going up, actually having a look at that and doing some sampling of that. And look, we're planning some sort of, like similar to Catalaya, we'll be doing some rock chip sampling and soil geochemistry to start with. Further on, I think we'll buy our own auger rig and we'll start actually drilling some auger holes in it once it gets granted, but we can't do that right now. So, and look, both these projects, I mean, they're generative by nature, and I just think they potentially could give our shareholders a lot of upside if we can find something there. Obviously, we've been watching what WA1 Resources have been doing, so, and look, we've got this opportunity in Brazil, so I just thought it's, really good opportunity for our shareholders. Just on, our gold in Kalgoorlie, obviously we're sort of in the heart of Eastern Goldfields. These are sort of projects that I've sort of personally held for a long time that I put into the IPO, so I've held them for about 30 years. We did a lot of drilling on them. We were very aggressive at IPO, so we did over 90,000 metres of drilling when we got started. So we basically put all the money into the ground, and we've defined a resource there that we've started a heap leach scoping study on at Mulgabby North, and also we've got our Patricia high-grade gold project. What I think the market seems to miss is that we're right next door to the Carosue Dam mill, and that's currently chewing through 4 million tonnes of ore per annum, and they'll be always looking for a home for more ore, and I think that's sort of one of the things the market's probably overlooked. Anyway, just on the exploration upside there's still lots of upside with our gold. I'm talking more about this because some of our shareholders have been giving us feedback that, oh, what are you doing with gold projects? You're not doing with them, you've forgotten about it. So I just want to reinforce the fact we haven't forgotten about our gold projects. There's still lots of scope there to do more work. I'm hoping the market will sort of turn around for gold for the junior end. At the moment it still hasn't, but even though we're seeing record gold prices of $3,700 an ounce, I mean, it's a fantastic mining environment, and my background is mining, so we definitely haven't forgotten about that. We've got lots of opportunity to drill in between our prospects there, which we haven't done to date. So we've got sort of 4 main prospects, the DMAG zone, the Ben and the James and the Alicia prospect. And basically that can be infill drilled, and that'll extend that resource considerably. Some really interesting things going on with the geology there. We're obviously seeing some intrusive porphyries there. We've done some seismic. We've identified some north-south faults, which one of them we haven't drill tested yet, but all the mineralisation that's seen at Carosue Dam is basically connected to north-south faults. So we understand the geology really well, and really we see some upside there for our shareholders at a point in time that we'll go back there and do some more work. We've also got the Patricia high-grade project. Again, that was another project that I've held personally for a long time. Again, we've done quite a lot of drilling there. We're quite aggressive at at IPO drilling there. So we've hit some great grades. It has been a bit sort of frustrating. It is structurally complex, but it was a high-grade producer historically, produced over 40 grams of a tonne gold. And obviously we're sort of still targeting high-grade mineralisation at depth there, and we'll revisit that at some stage. And just, I suppose, finally, why invest in Aurum? Look, we've got a proven track record of putting all the money into the ground. We still see Brazil as a fantastic opportunity to make a significant lithium discovery. We've got a very active acquisition strategy going on there, so we're currently in negotiations with a number of vendors of lithium projects there still, and we'll continue that process. I really want to see a pipeline of projects there so we can basically move through these projects in a sort of methodical process. And look, Brazil's got an excellent mining jurisdiction. It's a proven place you can get a project up and running. And I guess the niobium is another sort of part of the sort of strategy there. So we'll start that work, like I said, in probably the next 4 or 5 weeks. I'll be up there doing some work. And, I think that potentially could offer a lot of opportunity for our shareholders. And obviously we've got our West Australian gold. So they're advanced projects and there's still lots of exploration upside there. So thanks very much for listening with you today.
Thanks for everyone's time today, and look, it's great to be back in Sydney. This is obviously a hometown for me. It's been really nice catching up with a lot of my colleagues used to work with over many years in the capital markets. So thanks for everyone's time. I've got to say it's been a great turnout. Thanks to Jackson and the team from RIU. We've really enjoyed it and had a really good result, really good response to our recent updates. So look, this is an exciting one. Many of you will know Q Mines now. We've been listed for about 3 years. And just last week, mid-last week, we put out our maiden pre-feasibility study. And thank you for the introduction. As we talked about, we are a team that really moves. Okay, we're obviously younger and dynamic. We're big shareholders in the business. I've put a lot of my own capital into this business. We're here to generate value for our shareholders. All right. So as I said, we moved. So we've delivered 6 resource updates, a maiden reserve statement, and a PFS in under 3 years of being listed. So this really is one to watch. And please come around and see us at the booth. We'll give you a bit more context, but this is certainly an exciting one. All right, so I like to keep things really simple. So as we go through the presentation, you'll see I try and keep things very visual and try not to get too technical. All right, so the strategy is very, very simple. Okay, this is about Queensland, this is about copper, and this is about development. Okay, we know that there's a shortage of copper coming, and we know it's big. Okay, and we think that if we can get this asset into production, or a number of these deposits into production, right at the start of the next cycle, we're going to generate some really strong outsized returns for our shareholders. All right, what we're going to talk about today is our pre-feasibility study, amongst other things, and it's on our Mount Chalmers project there. You can see, in the large package closest to the coast. So it's very well located. We're just out of the regional town of Rockhampton. Okay, it's about 8 hours north of Brisbane. And as you can see, there's a boatload of infrastructure here. So we've got a really low capex advantage that you often don't see in the mining industry. This is not 500 kilometres from the nearest pub or the nearest post office. We're right very close to a large regional town with a lot of mining expertise and a lot of infrastructure. Last year, in August, we bought our second project here called Devlin Creek. We've initially purchased 51% of that, and in August this year, 12 months after, we've got the second payment coming up to also acquire that for 100%. So we plan to own both of these assets on a 100% basis, and we think that really gives us a really good structure from within which to generate value. All right, so let's talk about our flagship Mount Chalmers project. As I said, it's one of multiple deposits that are known, okay? This particular asset was the key asset that's brought into the feasibility study, okay, that we've now delivered a maiden reserve statement on, okay? And it's got some scale, it's got some grade, it's shallow, okay? Don't underestimate being shallow. And if you look at the orientation, it's actually flat-lying. Okay, so this isn't your typical steep dipping asset that goes underground quite quick and is quite high cost. This will be a low cost, ultra low cost open pit deposit that pays really strong returns early in the mine life and pays back capital really quickly. And the other key hint here is if you look closely at that block model at the top there, you'll see that a lot of the grade is actually at the top, okay? So this isn't your typical deposit where your grade gets better with depth, but also you've got a lot more material to move. There's a lot of great reasons here, just simple geometry reasons why this makes a lot of money, all right? So as I say, high grade, shallow, open pit deposit, low on the cost curve, and a lot of growth potential here as well. Now, as I said right at the start, we are unashamedly a younger team. This is my third listed business, and our last business we sold, many of you will know, we sold to a large US-based private equity group. We made a lot of money for our shareholders, and we're here to do it again, all right? We like these brownfields assets, and we like to move. We hate watching the grass grow. We like to deliver, okay? So I'll talk through some of these things we've delivered since we've been here. Okay, in terms of resource growth, I challenge you to find a group that really can push it out as quickly as we can, all right? We own our own rigs on site. We've bought all the farms around this mine site. That's really given us an ability to really rapidly develop this asset without all these complicated issues with dealing with landowners and trying to source rigs and waiting for all the downtime that's involved. So we move, all right? And this is our track record, okay? Since we listed, when we listed, we had 0 tonnes of copper in resource. We've now delivered 6 resource updates. And believe me, watch this space. It is not going to stop. This is going to keep going the right way. Now, in terms of the pre-feasibility study, many of you who have come through the booth have been wanting to know a bit more about this. Obviously, it's a big update for our business, okay? And I'll talk to the valuation side of it shortly. But we've delivered here a PFS just on our Mount Chalmers project. As I said, we've got 3 other assets or 3 other deposits that don't fall into this PFS, so it will continue to grow, okay? If you look closely at the slides here, you'll see we've optimised this within an inch of its life, okay? We're getting the best grades really early in the mine plan. That's great because it means it pays back capital really quick. It returns value to shareholders really quick. We're getting the highest amount of copper equivalent production really early in the mine plan as well, and so the same thing there. But what a lot of people don't understand is that these open pit, shallow deposits where there's very low strip ratio, good mets, good grade, just generate really strong returns, okay? And down there you can see our cash cost versus the spot price today. We've got an average cash cost of about $2.12 US dollars per pound over the life of this mine, okay? So this is a long life mine, 10.4 years. It's a low cost mine. We've got a capex there of about $192 million, which we think is infinitely fundable, and we've got really strong returns, okay? So this will pay back a lot of value to our shareholders really early in the mining cycle. The other point there is that we are, and as you'll see shortly, we are doing things differently, okay? We knew that, the big risk here is the permitting and approvals process, okay? We've had a lot of dialogue with the local regulator, and as you can see, a big part of our business plan has been about showing the regulator that we can develop this asset sustainably, okay? So we don't look at it for, other reasons. For us, this whole ESG concept is all about trying to get through this permit and approvals process, all right? So because of that, we've got renewable energy on site, we've got 2 solar systems, we've got wind turbines, we've got battery backups. We're using what we call AWTS systems, which basically mean that we're recycling our wastewater. We're using rainwater for drilling, and pit water for drilling. We're doing a lot of things here to show that we can develop this asset sustainably, all right? And, it's also important to know that, because of that, we actually are one of only 3 listed companies today that's certified carbon neutral, all right, under the rigorous Australian government-backed carbon neutral climate active certification. So we are doing things differently. We are best in class in terms of our environmental credentials. Okay, but as I said, we've delivered a fantastic result here with this PFS, but there is a lot more growth to come, okay? And that's a really key point of this presentation. There are a lot of deposits, other deposits here that we want to incorporate, okay? This is a VMS deposit. We know they cluster, we know there's going to be more of them, and we already have 3 of these that aren't subject to that normal exploration risk. And that basically tells you that these will come into the mine plan, these economics will continue to grow, and we will deliver more value for shareholders throughout the course of the year. Okay, Sulphide City and Scorpion are at our Devlin Creek project. They're higher grade, so they're higher grade than our Mount Chalmers deposit. There's a lot of upside here. We've about to start our maiden drilling program there shortly. We have an initial 10,000 metre drilling program. We're going to bring these 2 assets into the mine plan. We're going to grow these economics and hopefully really improve the grade there as well. And also at Woodshaft, which is only 800 metres away from our Mount Chalmers asset. Again, this is, we think, got a lot more scale potential. It's currently in the inferred category. We'll go and infill drill it. We'll do some extensional drilling this year, and we'll show that this will also fall into the mine plan and really goose the economics. We do have a lot of discovery potential here as well. We've got a very large package. Okay, it's a bit over 600 square k's. This is a belt scale district. There are multiple known deposits. I mentioned, we've already got 4 that are, in some sort of, JORC category, okay, that are already drilled and modelled, but there are others here as well that we haven't even got to yet. So, and to give you a sense of the opportunity here, I should mention that we flew a very large helicopter-borne EM survey over this whole package, start of last year. And it threw up about 40 different EM targets, okay? Now, EM's really good for finding these high-grade VMS deposits, all right? So we have exploration upside here in spades, and I really mean that, all right? So, as I say, we own our own rig. We've got a very large exploration program planned for this year, so there'll be lots of news flow on the way, and we're going to continue to grow this rapidly. Now, here's a little something different, all right? So, many of you will know I sort of worked in the capital markets a long time and ran a resources fund for 5 or 6 years, and so I'm really deep into the numbers, and I love diving into this. And obviously, as part of doing the PFS on the Mount Chalmers deposit, I learnt that there is a lot of value that you lose, in just delivering what they call concentrates to traders and things. Okay. So what we've started to think about on the back of that is how do we really maximise the return for our shareholders, and how do we really squeeze the rag, so to speak, and make sure our shareholders get more of that value. Okay, and to give you a sense, there's about $250 million that is in revenues, so it's not discounted, but in revenues that goes to transport costs, to metal payabilities to traders, to treatment and refining charges, or even to lost. There is some reductions in royalties that you can get with the state government if you continue to process more metals, in the state of Queensland. And so $250 million bucks. If you know me, I just don't sleep well with those sort of numbers. So we are. I won't say too much about this, but obviously we're talking about some updated strategies here. We are looking at how we can really squeeze that rag and maximise value for our shareholders, and it may mean building some additional infrastructure on site so that we can capture more of those, get these concentrates down to closer to refined metals, and really retain more value for our shareholders. So a little bit more to do on that space, but certainly an exciting bit of upside or potential upside for our shareholders. All right, so look, I'm going to hit the elephant in the room now, and obviously we are a team that have delivered, and I think that no one's ever come up to me and said, Sparky, you're not out there drilling, you're not growing the resource, and you're not taking this down the development path. So we are a team that is moving, but let's be really candid and look at that bottom line graph there, and say it has been a really difficult time for everything pre-production in copper. Okay, as you've probably seen, it's been tough for gold as well. We IPO'd at 30 cents. We're now at 6 cents. Okay, 6 cents. All right, and that's on the back of all that work that we've delivered. All right. We are a 14 million market cap business, and we are one of the next genuine Australian copper and gold producers. And I really believe these assets have that sort of potential. Okay, we've invested over $30 million in this business in the last 3 years, and we're at 14 million market cap. Think about that. Okay, and the way that we typically look at these, how we value these assets, post a PFS. And I notice there's many analysts sort of walking around the conference today. you typically look at about 20% of your what they call your net present value, per share, to look at where you should be roughly trading, give or take, at any given time. So 20% of our NPV today is 34 cents. All right, so that's almost a 600% upside for potential shareholders. So this is the elephant in the room. I'm happy to have the tough chat. It has been a tough period. But believe me, there is deep underlying value in this junior copper end, okay, particularly the developers. And we think we've really got something exciting here that's going to generate some really strong outsized returns for our shareholders as we take this down that development path. So look, thanks very much for everyone who's called past the booth, and I'd encourage you to come and say hello. Yeah, my name's Andrew. They call me the baby-faced chairman of the business. Come and say g'day. Our booth's just around the corner in the main room there. Really appreciate everyone's time, and good luck. Good luck with your investments.
Thanks, Chrissy, and thanks, ladies and gentlemen. It's a pleasure to be here in Sydney presenting at the RIU. I've recently become Chair and Managing Director of Boadicea Resources. We're now rebranding as BOA. I came on board at the end of last year in a board refresh for the company, and along with a board refresh, we've also had a strategic refresh as well. And the title of my talk is Positioned for Success, and I like to think that although we're small, we're positioning ourselves for the maximum success we can possibly have over the next 12 months with the drill bit. So we have a clear focus on exploration and discovery for lithium and nickel in Western Australia. We've got a terrific tenement portfolio in Western Australia, and our drilling program, drilling 4 of our tenements, 3 for lithium and 1 for nickel, is well underway. We've demobed a couple of weeks ago from our first lithium tenement drilling expedition, and I'll talk to you a little bit more about that. We do have some associated potential for gold and copper in some of our prospects, and I'll again show you a little more about where we're exploring. We have a focus on clear and proven geological provinces, and we like to explore near other producing mines or deposits so that our pathway to commercialising anything we discover is a little clearer for us. We have a partnership with RIU in the Fraser Range, and in fact Boadicea was an early mover in the Fraser Range, and we have a really nice tenement position with 14 tenements in that area. And as part of the Fraser Range, we're free carried through all the exploration on 6 of those tenements by RIU, who are the operator. We've been selling some of our non-core assets, A, to bring in some cash, but B, to cement our focus on the lithium and nickel exploration in Western Australia. So we're small, but I like to think not for long. Our market cap at the moment is a bit over $3 million. We've got a fairly open register, RIU being our only substantial shareholder. We do have some management buy-in, but most importantly for us is that our EV is very low and we're fully funded for our 4-program drilling expedition this year. Our people, we have a tight board. We have years of capital markets and exploration and discovery and commercialisation experience on our board, and that's going to come in handy over the coming months as we make some discoveries in Western Australia. So let's start talking about our portfolio. We're very focused on the Eastern Goldfields and Lake Johnson region for our lithium assets, and you can see here marked in yellow the 4 areas that we'll be drilling this year. We've demobed from 2 tanks up near Mount Ida a couple of weeks ago, and we'll be drilling our 3 lithium prospects in Bald Hill East, which abuts the Bald Hill mining licence, Cat Camp, and down at Fraser South. And I'll show you a little bit more about why we like these particular tenements. Let's start with our lithium. So we're going to be drilling 3 of the 4, again at 2 tanks, Cat Camp and Bald Hill East in Western Australia. And at 2 tanks, this is a tenement we have located in the Mount Ida province, and we did some drilling in 2023 that indicated, along with some of the surface geochemical work that we've done there, that if we focused our drilling in the future closer to the contact between the Copperfield granite and the greenstones, that we'd get some much higher lithium grades. So the focus of our drilling program that we've just undertaken is to target that higher grade potential, and we've drilled 20 holes for about 2,000 metres, much closer to this copperfield contact with the greenstones. You can see here we've mapped some pegmatites at surface, and this is what's evolving to be quite a prolific pegmatite corridor. And I noticed our neighbours at St George Mining this morning announced that they've got some high-grade surface pegmatites that they're planning to drill just to the south of us in the coming weeks. So it's going to be some exciting news coming from this part of the world, particularly for lithium exploration. So I can't talk about the results of the drilling just yet. We've sent 286 samples in for assay focused on lithium, but I can say that we did encounter in the field, in the drilling, some thicker than expected pegmatite sequences as we were drilling. So this is encouraging for us. We've just got our fingers crossed that we've got some mineralisation in there as well. And moving forward, we'll be drilling further south in Lake Johnson at Cap Camp. We've had this tenement for a few years, but we haven't undertaken any drilling there yet. But we've done some surface geochem, and there's been a number of drilling results, predominantly focused in lithium, which most of Lake Johnson was in the past, nickel, which most of Lake Johnson was in the past. And we're, of course, much more focused on lithium. We've done some surface geochemical work, and we've got some highly encouraging surface samples that have allowed us to identify a target area that we'll be following up again with about 2,000 metres of drilling, probably around June this year. Together with Cap Camp, we'll be back-to-backing a drilling program at Bald Hill East. This is one of our more exciting lithium exploration tenements. As I said earlier, it abuts the Bald Hill mining lease or licence, and from mapping that's been done, we've got strong indications that the mineralised zone extends to the southeast and into the southern part of our Bald Hill East tenement. We've undertaken some drilling on the northern section of this tenement in the last couple of years, but really the most exciting part for us is in this southwest corner of the tenement, where we see this potential for this mineralisation to be extended. It's been locked up in heritage overlay, and I'm pleased to say in January we announced that we had signed our agreement with the Ngaju people, and so we are now able to, it frees us up to drill, subject to completing our heritage survey, which we're embarking on in a couple of weeks' time. So we'll be drilling both Cap Camp and Bald Hill East in the middle of the year, about the end of, middle of the financial year, about the end of June. And moving on to nickel. Boadicea Resources was a first mover in this area and got a fairly large footprint of tenements in the Fraser Range area in the Albany Orogenic Belt some years ago. And back in 2020, signed an agreement with IGO where IGO would explore and pay all the costs of exploration on behalf of BOA across a number of tenements in this area. IGO, of course, have their flagship Nova Bollinger nickel mine, which is one of the lowest cost nickel mines in the world. And if you see IGO's results, you'll see even at depressed nickel prices, they're making quite a lot of money out of this Nova Bollinger nickel mine. But we do know that mine is in decline and it needs feedstock. And so together with IGO, we've been exploring for more nickel that can be fed into the coffers of the Nova Bollinger processing. If I start at the top, we have, if you look at this map, the tenements that IGO operate on behalf of Boadicea are the ones you can see labelled in black. And in the last couple of years, we've had some really good exploration results. We've actually drilled into two targets, one called Egg Pie and one called Ballast. And both of these are big ultramafic intrusives that are known to be the host rocks for the Nova Bollinger nickel, copper, cobalt style mineralisation. And in IGO's own words, these two discoveries or drilling results are highly prospective for potentially leading to another Nova nickel style deposit up further up the Fraser Range to where where the Nova nickel mine is. So Egg Pie and Ballast will be the focus of some follow-up ground electromagnetic data this year to define the size or the potential size of a mineralised zone, and then we'll be undertaking some more drilling with IGO to actually define what that looks like. But this is quite exciting for us and something that we're really keen to remain involved with. Our agreement with RIU actually expires in about 18 months' time, so we're looking forward to extending that so that we can continue some of this work with them, and they're keen to do that too. Down further in the Fraser Range, we operate a number of tenements in our own right, and one of them is called Fraser South. A few years ago, we undertook a large electromagnetic survey, both airborne and ground EM, and we found a booming electromagnetic anomaly that we've called the Snowies Prospect. It appears to be a large VMS-style anomaly, and we're looking forward to drilling that later this year. It's one of those anomalies that you just have to drill, as we know it's sitting on the side or the flank of another one of these mafic intrusives, and if this conductive anomaly is indicative of a large area of mineralisation, this is going to be really exciting for BOA in the coming months. And we're planning to drill that in Q4. Again, we have our heritage survey undertaken. We've got a conservation management plan in for approval, and we're expecting everything to get the green lights to be ready to be drilling by Q4. I mentioned earlier the RIU results and some of the work that we've been doing there. What's also really exciting about our tenement holding in this part of the world is that we have the Simons Hill tenement that sits right next door to the Nova Bollinger mining lease. A few years ago, RIU undertook a 3D seismic survey, which is highly unusual for the mining industry. It's not a tool normally used, to identify some of these mafic intrusives that are housing the mineralisation in the Nova area. Along this particular belt, these mafic intrusives are not a given, they come and go, and quite difficult to map because not all of them respond to airborne geophysical mapping techniques, and not all of them are conductors. And some of them, in fact, are dipping at depth beyond the reach or the resolution of airborne and ground EM techniques, even though we know that they could host quite large mineralised areas. So RIU have been indicating that they'd like to extend the 3D seismic survey into our Simons Hill tenement next door, which is going to be really exciting for us because it's going to open up a whole new swath of opportunities and prospects for drilling in there. And being right next door to the Nova nickel mine creates a great opportunity for BOA shareholders to be in something really large. I've included here a picture of some of the core that we took when we drilled Egg Pie, and you can see the sulphides that are hosting the nickel taken in the core, and it's giving us a lot of encouragement. This is exactly what the host rocks look like at the Nova Bollinger nickel mine. So I mentioned we're positioned for success. It's mostly around our drilling plans for this year. We'll be drilling both our two Cat Camp and Bald Hill licences in the middle of the year, and following that up with our VMS Snowies exciting prospect for nickel in Q3. And so we'll have some great results hopefully this year. We're fully funded for this drilling program. The company raised money this time last year, and together with putting on the new board and getting a new strategy, we're not letting any grass grow under our feet. We're getting the drill rig out there and giving our shareholders the greatest chance of success in the next 12 months or so. So we've affectionately called ourselves the Belle of Australia. It's really nice having BOA as a ticker, and we'd like our shareholders to think of us as that too. And even though we're small, we're positioned, as I said, for some growth, especially through the drill bit in the coming months. We're in these proven geological provinces. We have our agreement with RIU that covers a lot of our exploration funding. We're fully funded for our drilling that we're doing in our own right. And we've got a new reinvigorated board that's got a great track record in the capital markets. And touching on the topic that you raised, Chrissy, I added this morning after seeing the talk this morning. Actually 76% of our budgeted expenditure this year is going in the ground, and I know that that's quite a frustration for a lot of shareholders in junior mining companies, that the money is not being spent in the ground. So we're quite proud of that. The usual disclaimer, I encourage you to read in your own time, and please come and visit us at booth number 53. Both Yolanda and myself would love to meet with you and talk through the story some more. Thank you.
Yeah, thanks, Chrissy, for the kind words, and thanks to Stewie and Jackson as well for the opportunity to come and speak, be back here in Sydney. Here to talk about global lithium resources. We are now in our third year since listing as an IPO in 2021, best performing IPO in that financial year. And I'm really here to talk about three core pillars to our business, being our exploration focus, our project development focus, and our very sharp focus on approvals. We think approvals is likely to be the most challenging aspect of bringing the next wave of discoveries to market and being able to progress those projects through the development cycle and ultimately into production. Our company is incredibly well positioned in that regard. We've put a massive focus in working closely with the community from day one. And we've got a couple of great projects we own solely. So here to talk through those opportunities. First and foremost, typical disclaimer. So strategic highlights, I think first and foremost, we're multi-asset. We own two projects in the world's greatest two mining jurisdictions, in my opinion, being the Pilbara and the Eastern Goldfields. Both are JORC compliant, so 54 million tonnes at about 1.1% across both projects, but with significant upside ahead in terms of resource scale and growth. Importantly, we've demonstrated through metallurgical test programs at both sites some excellent recoveries, and these are full end-to-end, very significant MET programs, accounting for the best part of $3 to $4 million in spend, and a 14-month program. So we've proven geologically that both of our assets can be processed and producing a very high-grade lithium concentrate. Great jurisdiction to be mining, as I mentioned. We have some wonderful supportive strategic shareholders, one being Mineral Resources with 10%, and the other being one of the largest lithium hydroxide producers in China, a company called Canmax, and again, being wonderful strategic supporters from day one. Experienced board. The board's got more than 180 years of cumulative resources experience, and all of our directors are based in Perth, so it gives us a great opportunity to get together and talk strategy. And in this current market in lithium, we've got a really sharp focus on M&A. We've got about 30 million in the bank, so incredibly well capitalised, and a very aggressive growth schedule. So I'll talk through about some of those opportunities throughout the course of the preso. Corporate snapshot, a very tight register, 260 million shares on issue. As I said, about 30 million in the bank. We also have a strategic investment in a company that's got tenements immediately adjacent to our Mana project in the Eastern Goldfields, a company called Kairos Minerals. About 3 million in equity in that particular asset. And the balance of our register is high net worth individuals, board and management with a reasonable skin in the game, and then retail and institutional. As you can see there, as with most lithium stocks, we've been beaten up over the last sort of 12 months, but certainly we're seeing commodity price stabilise and elevate, and my expectation is, back end of Q3 and into Q4 this year, we should see some meaningful recovery. And at that point, we'll be one of the only companies on the planet that, is likely to have a mining lease in hand, and also DFS that is nearing completion. So we'll be in a wonderful position to capture the upside as it comes to fruition back half of this year. The board, Jeff Jones, 10 years at GR Engineering Services, one of the major EPC firms based in Western Australia. Great technical capability, and Jeff's offered a lot to the business since he's joined. The other role I have when I'm not managing the business is I'm the chair of the London Metal Exchange Lithium and Cobalt Committee. I've been in that role for about 4.5 years. Dr. Chen, a mining engineer by background. Hayley Lawrence, commercial lawyer, also heads up our corporate governance. And Greg Lilliman. Greg, very experienced mining executive and spent 20 odd years at RIU, and he was 2IC to Andrew Forrest at Fortescue Metal Group, and Kevin Hart, our co-sec. But we've got a great management team as well, a number of which are at our booth, so please I encourage you to drop by. So I'm here to talk about our Mana lithium project. It's our flagship project. It's the 7th largest lithium resource in Australia, and one of the largest that's non-developed. So we are a pre-production. We're moving now into a formal development process. Importantly, we've got wonderful development optionality because we own the asset outright. We don't have any royalty overhangs, and that, of course, gives us fantastic optionality taking this project forward. Great jurisdiction. It's a spodumene dominant ore body, and that's important because spodumene is what the end market is looking to process. into chemicals. There are a number of other ore bodies in and around Western Australia which are not spodumene dominant, so do encourage you to do your research. When a company announces a lithium oxide grade, we have spodumene, and that's what the market is demanding. A 36 million tonne resource currently. We are expecting improvement in that. We're only 2 years into a drill campaign, so just to put that into perspective, we are expecting through subsequent drill campaigns that resource will grow over time, and we are expecting an MRE update to the project actually this month. A great place to be mining. We've got a very significant land holding. It's increased about 280% since January last year. One of the only projects that's got an operational rail line immediately adjacent to the project. We've got the Trans-Australian Rail Line, which runs 8 kilometres south of Manor, and we are looking to utilise this logistics pathway for our project going forward. There is other fantastic capability in the region. Obviously, being close to Kalgoorlie gives us great access to not only expertise but also consumables for the project. And again, we are the second largest lithium resource in this particular province, of which there's a number of lithium assets. Exploration, I mentioned, is a key focus for the business. We've completed about 100,000 metres of drilling, a combination of RC diamond, both infill extensional drilling at the asset over the last 2 years, and we've just kicked off our third consecutive exploration campaign. A smaller campaign this year, but highly targeted and purely looking at extensional drilling. So we are expecting our MRE to be announced very soon. We completed around 60% of last year's campaign was infill, 40 by 40 metre spacing, so we've got a really, really excellent understanding of the geology of the asset, and that's really been underpinned by a metallurgical test campaign which is recently completed. So we're having great progress, and we expect more to come in terms of the exploration upside across the asset. So this just shows the geology. Most of the drilling we've undertaken to date has been intercepting outcropping targets at surface, a number of spodumene outcropping targets. What we're looking to do this year is focus on some undercover targets to the southwest of the existing asset. That's about a 5 kilometre strike, and we think there's potential there to certainly extend that resource significantly downstrike along the Manor Fault. So our geology team is in the field, incredibly excited, and we'll be bringing those results to market over the course of the next couple of months. We've done a lot of work around the DFS modelling. This is a verified static image of the pit. In green there you can see the indicated resource, in blue the inferred. This is looking on a north trend. We've got the waste dumps either side of the open pit, and the focus for this year's exploration is to potentially bring in a third pit to the south of the existing resource. So again, a significant amount of work has been done. To the previous speaker's point, I love that comment around putting money in the ground and into technical work. Because we're well capitalised, we've been able to do a lot of work in terms of de-risking this project. So when we do announce that DFS at the back end of this year, we can do so with absolute confidence. The DFS is well advanced. We are looking to conclude that back end of Q3 this year. The pullback in the market's given us a wonderful opportunity to further optimise the project. We've got GR Engineering Services currently engaged undertaking a site layout review, but also a CapEx optimisation. So we'll see some improvement in the total CapEx here. We also have SRK undertaking a review of our mining costs and our mine schedule. So again, having these independent technical experts review our project means when we announce it, it will absolutely be bulletproof and a very competitive project. So it's great to have the calibre of these individuals involved in our assessment. I talked about metallurgy. Metallurgy is critical. If you don't have the right met, you don't have a project. It's as simple as that. And you've got to spend money on the metallurgy. As I mentioned earlier, close to $4 million spend across both projects on our MET program. We're using the most sophisticated metallurgical lab in the industry, Nagron, based in Perth, and we've adopted a whole of ore. So this is a locked circuit, a whole of ore flotation, and it's quite a simple circuit. And it's a proven circuit, most importantly. Whole of ore flotation has been adopted in Western Australia for more than 30 years. So low risk with this technology, and we're getting some super high grades. We've spent a lot of money and a lot of time on our MET. It's really important. 66 individual flotation tests, and again, we're getting around 75% recovery. And that's from the run-of-mine pad all the way through to the final concentrate. So we're thrilled with that progress. We're doing some additional work on the met, and we'll be announcing that probably in the third quarter of this year. The other core pillar, as I mentioned earlier, is approvals and permitting. We've, again, put a huge effort into an early front door approach with regards to our native title negotiations. We are very much at the pointy end of those negotiations, and we're hoping to conclude an NTMA, Native Title Mining Agreement, in the next couple of months, which will pave the way for our mining lease to be granted in Q3. So again, we'll be one of the few companies on the planet in the lithium industry that has a mining lease in hand. And that allows us to be shovel ready when that market does rebound the back end of this year. The other key part of approvals obviously is environmental. We've completed all of our fauna flora surveys, both spring and autumn, across the project site. It's completely heritage surveyed. There's no areas of cultural significance within the project site, which is wonderful for us. So we're expecting no EPA referral, most importantly, so no delay on enviro approvals. So again, early engagement there, and we put the team to work very early on in terms of getting our enviro approvals. So in a great position across both of those. And most importantly, as I mentioned, that mining lease is pivotal. To be shovel ready, you need that mining lease in hand, so we're very much on track. A couple of photos of the project site. Wonderful place to be mining in the Eastern Goldfields. It's flat. It's a flat jurisdiction. Access is good. There's no local communities, and of course, there's no permanent water. So this is good both from a native title and an environmental perspective. So lots to look forward to. Operationally for us, this next couple of calendar quarters will be the busiest for the year. We've got a really prudent approach to spend, given where the market's at. Of course, exploration, metallurgical results coming to market. We do have a mineral resource estimate update, which will come to market in the next few weeks. Environmental native title approvals will be announced once they conclude. And of course, the drilling results will come to market in the third quarter. The mining lease in hand come Q3, and the DFS will wrap up by the back end of this year. So the interest from the downstream strategic part of the industry more broadly is as strong as ever. We've received a number of really well-credentialed offers around partnership and offtake, but our view is we really want to, offtake is our weapon very much, and as soon as you give it up, you reduce your commercial leverage. So we've got 70% of our offtake uncontracted. So by the time we conclude all of these critical deliverables and that market's on the improve, we'll be in a great place to execute those particular agreements. We have another project, Marble Bar. This is land banked. This is an 18 million tonne resource at 1%. Great place to be mining again. We've got access to a sealed road. There's a couple of monster projects to the west of us in Pilgangora and Wodgina. And this project for us, we're just going to leave it in the ground for the next 12 months. We'll come and look at this in 12 months from now. The market will be on the move, and we'll get much better value from a development perspective. As Chrissy mentioned, we've been doing some amazing work in the local communities across both of our project sites. It's core to our business. It's part of our value as a company, and we'll continue to do so. So with that, I'm ahead of schedule for the first time ever, I think, Chrissy. So thanks very much.